Tokyo, July 31st, 2024, 12:13 in the afternoon. Inside the Bank of Japan, 9 words were about to move more money than most countries earn in a year. The board votes to raise interest rates from near zero to 0.25%. Sounds small, a rounding error even, the kind of number that belongs in a spreadsheet, not a headline. 5 days later, the Nikkei will have its worst single day since 1987. $670 billion will vanish from Japanese stocks before lunch. And on the other side of the planet, the S&P 500 will fall right alongside it. This is the story of how one quarter-point decision in Tokyo detonated a trade worth hundreds of billions of dollars, and why the fuse was actually lit 2 years earlier in Washington. To understand August 5th, you have to understand the trade everyone was making without ever saying its name out loud. For almost 3 decades, Japan kept interest rates near zero. At one stretch, they even went negative, which meant one thing to every hedge fund and trading desk on Earth: Japan was the cheapest place in the world to borrow money. So the trade was simple: borrow yen for almost nothing, convert it to dollars, put that money into something that actually pays: U.S. tech stocks, U.S. treasuries, emerging market bonds, and pocket the difference. It's called a carry trade, and by 2024, estimates put its size somewhere between $500 billion and $1 trillion. Nobody knows the exact number because nobody has to report it. It lives in the shadows between currencies. Then, in February of 2022, the Federal Reserve started doing the opposite of Japan. Fighting inflation running near 9 and 10%, the Fed dragged rates from near zero up to 5.5% in under 2 years. That gap, cheap yen on one side, expensive dollar on the other, is what fed the trade for 2 straight years. It was the widest interest rate gap between the two economies in a generation, and the wider the gap got, the bigger the trade got. But for every gap that opens is a gap that can close, and by the summer of 2024, it started to. 2 things happened almost at once. The Fed began signaling it was done hiking, maybe even ready to cut. And the Bank of Japan did the one thing that nobody had priced in. It hiked, and signaled it might hike again. That's the moment that the math flips. When the currency you borrowed in starts getting stronger and the currency you invested in starts getting weaker, the trade that made you money starts eating you alive. The yen didn't drift, it surged, gaining roughly 6% against the dollar in just 1 week. For a trade built on borrowed money and leverage, 6% in a week isn't a correction, it's a margin call. And when a trade this size needs to unwind, it doesn't unwind quietly. Everyone is trying to sell the same assets and buy back the same yen at the same time through the same narrow door. August 5th, 2024, Monday morning in Tokyo. The Nikkei 225 opens and simply falls apart. Down 12.4% by the close, the single worst day for Japanese stocks since Black Monday 1987. Worse than anything in the 2008 financial crisis. Worse even than the pandemic crash of 2020. $670 billion in market value gone in one session. Now the shockwave doesn't stay in Tokyo. It can't, because the money that was unwinding was never really Japanese money. It was borrowed yen sitting inside American tech stocks, European bonds, and emerging market currencies from Mexico to Australia. So when Tokyo opens the trapdoor, Wall Street falls through it too. The S&P 500 drops 3% that same day. U.S. Treasury yields, which had sat near 4.3% just 2 weeks earlier, collapsed toward 3.7%, one of the sharpest short-term moves of the entire year. In a matter of days, traders who thought they understood their risk discovered they were standing on a structure wired to a switch 20 minutes away that they never controlled. Here's what almost nobody outside trading floors understood in that moment. The panic wasn't really about Japan's economy. Japan's economy, after all, hadn't changed overnight. What had changed was the price of borrowed money, 0.25 percentage point in one country that unraveled a trade built across a dozen others. Within weeks, the most aggressive, most leveraged bets on the trade were gone. Data from future markets showed speculative positions against the yen falling to roughly 1/4 of where they'd been at the peak. But the trade itself never fully died. The underlying force behind it, Japanese pension funds, insurers, and institutions still parking money abroad in search of yield, never really went away. It's structural, not speculative, which means the conditions that built the trade in the first place are still there. And that's the part that should stay with you. This wasn't a story about a crash. It was a story about how connected the modern financial system really is. How a committee vote in Tokyo can reach into a retirement account in Ohio before the person who owns it has even finished their coffee. The next rate decision in any of these rooms is never just a number. It's a wire running under the entire global economy. And most of the time, you don't find out where it leads until something pulls it.